The key factor in getting the tax compromise passed was the fact that something had to be done. If Congress didn't act, if the president didn't get involved, if the tax law played out the way it was scheduled, all of the 2001-2003 tax cuts would have expired. The alternative minimum tax would have hit 26 million taxpayers. The revenues would jump a lot, bring a lot of wealth out of the economy, and reduce demand quite a bit. Big hit on the economy. It's the fact that the default was much worse than any change going forward that gave room to both sides to compromise. The Republicans were willing to give in on allowing some provisions in the 2009 Stimulus Act to continue, to allow extension of the unemployment insurance that was going to shrink at the beginning of the year. The president was willing to give in on a temporary extension of tax cuts for the wealthy individuals, something he'd campaigned against in 2008 and been arguing that we really can't afford to continue the tax cuts for the wealthy, and was willing to give something on the estate tax. The compromise allowed a tax bill to be passed and allowed us to avert the big tax increase that otherwise would have occurred. For the most part, extending the taxes for the next couple of years means nothing's changed. The 2001-2003 tax cuts continue. The alternative minimum tax is patched, so only 4 million people will be affected by it rather than 25 or 26 million people. Essentially everything will be very similar. The two big differences are we lose the Making Work Pay Credit, which provided up to $400 per individual, $800 per couple for workers. It was replaced with a 2 percentage point reduction in the payroll tax, which could mean up to a $2,100 deduction for individuals and twice that for couples, potentially. The big difference there, though, is people at the bottom of the income distribution, low-income workers, did better under Making Work Pay. If you were a single worker earning less than $20,000, married couple earning less than $40,000, you're going to be worse off because your savings on the payroll tax cut will not be as large as what you got from Making Work Pay. Conversely, people at the top end of the income distribution are much better off under the payroll tax cut. The Making Work Pay credit disappeared for couples with incomes above $190,000, individuals with incomes above $95,000. Those people now, with the payroll tax cut, can get as much as $2,000 or $4,000 cut in their taxes on the payroll tax side, where they were getting nothing from Making Work Pay. So it's a very non-progressive, a very regressive payroll tax change, giving the biggest benefits to the highest income workers, smaller benefits to low-income workers. And in fact, as a result of that change, about 50 million households will see their taxes go up in 2011 compared to 2010 because they lose the Making Work Pay and don't get as much back from payroll tax cut. On the other side of the coin, 73 million households will be better off because of the trade-off. They get more from the payroll tax cut than they were getting from Making Work Pay. Otherwise, essentially everything's the same. The 2001 Tax Act phased away the estate tax, reduced it over time to the point where it was completely repealed for 2010. During 2010, at least 5 people worth more than $1 billion died, and their estates owed no estate tax because there was no estate tax for the year. If the 2001 Tax Act had carried through, it was sunset at the end of 2010, and this year we would have had an estate tax that looked a lot like what we had back in 2000, with a $1 million exemption and a 55% top tax rate. That would have subjected about 44,000 estates to estate tax in 2011. Instead, what was passed in the compromise tax bill was a much higher exemption and a much lower tax rate. Estates worth more than $5 million would be subject to tax, but those worth less would face no tax at all. And the tax rate on the high wealth estates would be 35%, much lower than the 55% tax that would have occurred had the compromise not been extended to include the estate tax. So as a result, we're going to see as few as 3,600 estates subject to tax, fewer than a tenth as many. Less than 0.2% of people dying in 2011 will see their estates subject to tax. And we'll lose a lot of revenue as a result of that. What was clearly the case is if we allow all the tax cuts that were scheduled to expire at the end of last year to expire, in fact go away, we would have had a big hit on the economy. Not a stimulus, but a negative stimulus, making the economy much, much worse off and threatening our rather weak recovery. It would have pulled a lot of money out of the economy, out of people's pockets, would have cut spending a lot, and therefore would have put a damper on the economy. As a result of extending them, we didn't have that hit. The question is, did we add anything new that would stimulate the economy beyond where we were? And the big thing there, again, is the payroll tax cut that will put $110 billion into the economy this year that otherwise wouldn't have been there. That will have a stimulative effect on the economy. It will dribble into people's paychecks. Each paycheck will be a little larger than it otherwise would have been because not as much will be taken out for payroll taxes. And people will either spend that, save it, pay down their credit card balances. To the extent they spend it, it will stimulate the economy. It will make the economy better by increasing demand for goods and services. The problem is that much of the value of that payroll tax cut goes to wealthy individuals who are much more likely to save any tax savings than to spend them. If the money is directed to people at the bottom end of the distribution, almost every dollar coming in the doors can go right back out again to cover basic needs. So a dollar's tax cut will result in a dollar spending and a boost to the economy immediately. The same dollar given to a wealthy person, part of it will go into savings, part of it will be spent. Much smaller effect on demand and much smaller boost to the economy. In essence, what you want to do is direct as much money as possible at the bottom of the distribution where people spend a larger share of it. You get bigger bang for your buck from spending money down there. And that's what the Making Work Pay credit did. It directed more money to the bottom of the distribution, virtually nothing to the top of the distribution, and bang for the buck, much more effective stimulus. It was much smaller. The payroll tax cut is roughly twice as big as Making Work Pay was, about $110 billion for the payroll tax cut versus about $60 billion for Making Work Pay. So being much larger, even though it's less effective dollar for dollar, it's probably going to have a large impact on stimulating the economy and keep our recovery going.